I mean, think about the math for a second. If your portfolio drops by 50% during a market crash, you don't just need a 50% gain to recover.
Right. Not at all.
You actually need a 100% gain. Like, you have to literally double your money just to get back to zero.
Yeah, it's the brutal reality of drawdowns.
Exactly.
Yeah.
So today, our mission for this deep dive is looking at how the smartest institutional money completely avoids that mathematical trap. And, how we can apply their exact strategies to navigate what is currently a deeply divided, frustratingly choppy market.
It is choppy, and retail investors, they often spend, a decade just trying to claw their way back to break even after a major drawdown like that.
A whole decade, wow.
Yeah, and the sources we're pulling from today, ranging from live trading session transcripts to macroeconomic risk strategies and even some technical crypto analysis, they all point to one core philosophy.
Which is?
You survive muddy waters by completely ignoring that visceral urge to pick market bottoms, and instead you just rigorously follow institutional momentum.
Right. And we are also pulling from this really fascinating interview with a consumer staples disruptor today because, well, this principle of following momentum, it doesn't just apply to technical stock charts.
No, absolutely not.
It applies to massive fundamental shifts in consumer habits, too. But before we get to the specific price action and the anomalies happening today, we kind of need to fundamentally rewire how we think about risk.
For sure.
Because the macro source we're analyzing, it goes hard after a very specific, very common trading behavior.
Yeah.
The absolute fallacy of trying to pick tops and bottoms.
Oh, yeah. The data is incredibly explicit on this point. I mean, think of legends like Warren Buffett, Paul Tudor Jones, Jim Simons, Ray Dalio.
Right, the heavy hitters.
The absolute heavyweights. And none of these investors have ever consistently picked the exact top or the exact bottom of a market cycle.
Wait, really? Not even Jim Simons?
Not consistently, no. They don't even attempt it. Trying to catch a falling knife in a declining market, it just exposes investors to massive lifestyle-altering errors.
It reminds me of watching Steph Curry shoot half-court shots during pregame warm-ups.
Oh, that's a good analogy. Yeah.
Like, just because it looks incredibly cool when he sinks one doesn't mean you should grab a basketball, run onto the court in the middle of an actual game, and try to hurl one from the logo yourself.
Exactly. You're just going to airball and embarrass yourself. Or, in the case of trading, blow up your entire account.
Yeah, you'll be benched immediately.
Right. The pros are playing a completely different game. What the smartest institutional hedge funds, specifically these multi-manager pod shops, what they're doing instead is focusing intensely on a mechanism called volatility targeting.
Okay.
And they pair that with dynamic position sizing.
Okay. I want to break down the actual mechanics of that because it sounds fancy, but when you say volatility targeting, how does a pod shop manager actually execute that on a daily basis?
Well, it really comes down to monitoring the VIX.
The fear gauge.
Exactly, the market's fear gauge, or volatility index. And they mathematically tie it to their exposure. So when volatility spikes, meaning the market is swinging wildly and becoming unpredictable, their algorithms just automatically shrink the size of their positions.
Oh, so they aren't having a big meeting about it.
No, not at all. They don't sit around a mahogany conference table trying to guess whether the market will swing up or down that day.
Right.
They simply reduce their overall exposure to the chop. Their entire objective is to compound returns near their peak net asset value. They are completely avoiding deep drawdowns.
Let me push back on this philosophy, though, because it kind of flies in the face of traditional financial advice. I mean, we're constantly told to just buy and hold.
The classic advice.
Right. The logic is that if you just wait it out, the broader market always recovers eventually. So why shouldn't an investor just, hold their nose, ignore the volatility, and wait?
Because time is the one asset you cannot recover.
Okay.
The macro data we're looking at, it maps out the S&P 500's history all the way back since 1928. Historically, the index spends 25% of its time down 30% or more from its all-time highs.
Wait, 25% of the time?
Yes, a quarter of its entire history. And for an asset class like Bitcoin, it spends 2/3 of its existence in a drawdown.
That's wild.
Yeah, so yes, the market generally goes up over a century. But if you are 55 years old, you cannot afford to spend the next 10 or 15 years in a 30% hole just trying to get back to where you started.
Right. You don't want that specific quarter of market history to perfectly aligned with a quarter of your life when you actually need the capital, like for retirement.
Exactly. And the source material highlights this mathematical model comparing two identical portfolios, right? Both are generating a 50% average annual return.
All right.
But the one that dynamically managed risk, the one that stepped aside during the worst drawdowns, it ended up with 70% more money by year 3.
70%. Just from stepping aside.
Just from avoiding the craters. Because it was compounding on a larger base amount rather than spending years trying to dig out of a massive hole.
Man. So taking that risk-averse, smart money philosophy, we can now apply it directly to the price action mapped out in today's live trading transcript.
Yes, let's look at today.
Because the trader highlights perfectly how dangerous it is to ignore the current market chop. The broader indices, specifically the ES tracking the S&P and the NQ tracking the NASDAQ, are just completely trapped in a sideways consolidation right now.
They are completely stuck.
And I'm looking at this live trading source, and they're pointing out demand lows like the NASDAQ at a 29,208 level.
Yeah.
But the trader is explicitly warning against buying that dip.
Right.
Usually, you see a demand low, you think, okay, that's my historic support, it's time to step it in and buy. Why are they completely ignoring traditional support lines here?
Because the market environment has shifted. Those traditional support levels, they're not yielding true bounces right now. Well, when retail traders buy that demand low, the price pops slightly, right?
Yeah.
And that traps them into thinking they caught the absolute bottom, but then it immediately fades right back down.
Yeah.
You're just not getting rewarded with momentum for taking that risk.
Which brings us to the concept of the no trade zone, or the NTZ.
Yes, the NTZ.
And the S&P 500, the trader maps out this massive choppy box. It's between, let me check the numbers, 7,632 and 7,724.
Yeah, that entire range. And inside that specific zone, you have heavy 4-hour supply highs pressing down from above, and then previous demand lows pushing up from below.
So it's just squeezed.
Completely squeezed. Price action just violently ping-pongs between those two barriers. If you try to trade inside that box, you are just going to get chewed up by institutional algorithms.
Because they're hunting retail stops?
Exactly. They are designed to hunt retail stop losses in that exact chop.
Okay, so if the main indices are essentially a trap right now, what does a high probability setup actually look like? Like, where's the actionable anomaly?
Right. Where do we go?
Yeah. The live trading transcript shifts the entire focus away from support lines and toward this vacuum effect of gap fills. Specifically, they're obsessing over a gap on the QQQ starting at $707.53 down to $701.59.
Yeah, and there is also a massive gap on the semiconductor ETF, the SMH, sitting down at $545.46.
Okay, I need to understand the underlying mechanics of this because it sounds kind of counterintuitive. Why is a gap fill considered a safer or more actionable trade than just buying a traditional proven support line?
So think of a stock chart's historical price action as traffic on a highway.
Okay, traffic.
When a stock trades heavily at a certain price, thousands of buyers and sellers exchange shares. That creates traffic. But when a stock gaps down or gaps up overnight, maybe due to an earnings report or some macro news event, the price completely jumps over a large section of numbers.
It skips it entirely.
It skips it. Absolutely zero shares exchange hands in that middle zone.
So it essentially creates a highway with absolutely no cars on it.
Precisely. It's an empty road. So when the price action eventually re-enters that specific zone later on, there is no historical order book.
Right.
There are no buyers sitting there defending a level they bought at previously, and there are no trapped sellers waiting for the price to return so they can exit at break-even.
Oh, that makes so much sense.
It creates a low-volume vacuum. Once the QQQ drops below that threshold at $707.53, the lack of friction means the price tends to slide rapidly and cleanly all the way to the bottom of the gap.
It's just a much higher probability momentum trade than betting on some random bounce in the middle of a choppy no-trade zone. So we have traditional tech indices stuck in this gap-filling purgatory, and semiconductors are looking weak. If the institutional volume isn't in traditional tech, where is the capital actually flowing?
Well, the charts show a massive rotation out of traditional tech and a very aggressive inflow directly into crypto and crypto-adjacent equities.
Really aggressive.
Yeah. Looking at the Setup Sunday source, the sheer volume is staggering. Bitcoin saw a positive $2 billion weekly inflow.
2 billion.
$2 billion. That is the largest capital injection the asset has seen since May.
Wow. And the source also points to smart money positioning using COT data. Now, for a listener who isn't deep in the commodities or futures world, what exactly is the commitment of traders report, and who qualifies as the smart money here?
Sure. So the COT report is a weekly publication. It shows the aggregate holdings of different participants in the U.S. futures market.
Okay.
And the key demographic to watch here is the commercial traders. These are the massive institutions and corporations that are actually hedging real-world risk, not just retail speculators gambling on direction.
Right, they're the ones moving the market.
Exactly. When the commercial traders make a move, that is considered the smart money. And right now, the data shows they are significantly reducing their net short positions on crypto.
Meaning they're pulling back on their bets that it's going to go down.
Yes. They are taking their bearish bets completely off the table.
And the technical setup aligning with that inflow is Bitcoin pushing up against the daily Ichimoku cloud, right around that $70,000 to $72,000 level.
Yes.
I hear Ichimoku cloud thrown around constantly in technical analysis, but what is it actually illustrating on the chart?
Well, it literally looks like a shaded cloud hovering over or under the price candles.
Okay.
Mathematically, it plots multiple moving averages to create this dynamic zone of future support or resistance. When a price is stuck inside the cloud, the trend is messy and volatile.
It's turbulence.
Pure turbulence. But when Bitcoin pushes up and breaks above that cloud, it is like an airplane climbing out of a dense storm into clear blue skies. The historical resistance is gone, signaling a massive potential breakout.
Well, that's a great visual.
And furthermore, Ethereum is holding incredibly steady above $2,000, which the analyst points out is prime bid territory even on days when the broader market is down.
I am looking at the broader macroeconomic context right now, though, and I kind of have to push back on this extreme technical optimism.
Okay, let's hear it.
Both the crypto analyst and the live trader openly acknowledge that historically September is a terrible month for equities.
It usually is, yeah.
And on top of that, you have major geopolitical headwinds in the Middle East and constant, totally unpredictable talk from the Federal Reserve about interest rates. Like, if a war escalates or rates don't drop, a beautiful chart setup gets destroyed instantly, right?
Yeah.
Are we supposed to just completely ignore the macro reality and blindly trust lines on a chart?
Well, this brings us to a core debate in trading philosophy.
Okay.
The crypto source explicitly argues that technical analysis leads the way, and the reasoning goes far beyond just trusting lines on a screen.
What do you mean?
Institutional money, the firms deploying billions of dollars, they have massive research arms, they have satellite imagery of supply chains, they have real-time credit card data, they have political back channels.
They know things we don't.
Exactly. They get the fundamental information long before retail traders or the mainstream media do.
So you're saying their buying activity, which is what creates the breakout on the chart, is actually the earliest available signal of the fundamental news.
Exactly that. Price action is information. If Bitcoin is violently outperforming the S&P 500 and breaking out above that daily Ichimoku cloud despite terrible September seasonality and geopolitical tension,
Right.
that relative strength is the market telling you that the institutions have already priced in the fear and they are buying anyway.
Wow. And
Yeah.
that institutional buying creates a massive ripple effect into equities, which the live trader was actively hunting.
Yes.
Because while the rest of the market was stuck in the no-trade zone, capital was aggressively flowing into crypto-adjacent stocks. The trader was heavily focused on Robinhood, looking for the stock to hold the $106 to $108 level for a VWAP reclaim.
Yeah, and VWAP is the volume-weighted average price. It is arguably the most important metric for day traders.
Why is it so important?
Because it acts as the true center of gravity for a stock on any given day. It factors in where the heavy institutional volume is actually trading, and it filters out the low-volume retail noise.
So when stock falls below it, the trend is broken. But reclaiming the VWAP level means the big money is stepping back in and taking control of the price action again.
Yes, exactly. Reclaiming VWAP at that specific 106 level on Robinhood provides a clear, highly actionable entry point with a defined risk.
Right.
The trader was also eyeing Coinbase holding above the $177 to $181 level, while noting extreme relative strength in Circle breaking out over $87.
It perfectly illustrates our core theme today, doesn't it?
It really does.
Do not force trades in a choppy sideways index. Just follow the institutional momentum to where the order flow is clean and trending.
Exactly. Follow the money.
So in the stock market, smart money hunts for vacuums, like those gap fills on the QQQ, where there is no historical friction. But smart money in the venture capital and consumer space hunts for a completely different kind of vacuum.
A very different kind.
They look for massive gaps in human habits. And our final source today points to a literal fiber gap that is completely upending a century-old industry, entirely defying broader market chop.
Yeah, this was fascinating. The interview with Ben Goodwin, the CEO of Olipop. It's a masterclass in how institutional money identifies and capitalizes on generational megatrends in consumer staples.
Goodwin is a really fascinating figure. He dropped out of college at 20 and spent the next 2 decades cutting his teeth in the beverage industry. He actually launched a probiotic soda company prior to Olipop, but he had to fold the business.
Yeah, and the reason why is so interesting.
Because natural health food stores on the West Coast absolutely despise the word soda. They associate it entirely with toxic sugar water.
Right, so he pivoted his strategy based on regional linguistics and human behavior.
Exceptional.
He realized that in the Midwest, they don't call it soda, they call it pop.
Pop, yeah.
So he combined Oli from oligosaccharides, which are the complex prebiotic fibers used in the drink, with pop, creating an entirely new beverage category, Olipop.
And the underlying fundamental anomaly they are attacking is a staggering health metric. 90% of Americans do not get the USDA's recommended 28 grams of daily fiber.
90%. And that deficiency isn't just some minor dietary issue. It is a primary driver behind the massive metabolic health crisis sweeping industrialized nations.
This is a huge problem.
Nearly 50% of the American population currently suffers from prediabetes or type 2 diabetes. The modern diet has completely stripped away the necessary fiber required to regulate blood sugar.
But the true catalyst that is shifting market fundamentals right now and drawing in massive institutional investment revolves around GLP-1 weight loss drugs like Ozempic.
Yes.
Because for a while, legacy food and beverage executives were publicly claiming they weren't seeing any real impact on their snack businesses.
Yeah.
But Goodwin confirms from his internal data that they absolutely are seeing a shift.
Oh, the statistics are remarkable. 50% of patients on GLP-1 medications completely stop drinking traditional soda.
Half of them. Just stop.
Half. The drugs fundamentally alter their satiety and reduce their cravings for massive sugar loads. However, when those same users are surveyed, they universally admit that they deeply miss the behavioral experience of drinking a soda.
They miss the ritual.
Exactly. The carbonation, the flavor profile, the ritual of opening a can with a meal.
It is like Olipop is hacking human nostalgia.
I like that, yeah.
They're taking the familiar RC Cola or Crystal Pepsi operating system that we all grew up with, that deeply ingrained consumer habit, but they are completely replacing the malware, which is the high fructose corn syrup, with a healthy fiber patch.
That's a perfect way to put it. And Goodwin explicitly refers to the product as a Trojan horse.
A Trojan horse.
They are delivering up to 9 grams of dietary fiber directly into the consumer's system via a nostalgic, comforting format. They have even published clinical research demonstrating that consuming their product keeps a user's blood sugar stable for up to 3 hours afterward.
Wow.
They have solved the metabolic problem without asking the consumer to sacrifice the experience.
And the financial result of filling that behavioral vacuum is staggering. Olipop has scaled to well over $500 million in profitable revenue.
$500 million.
And unlike many upstart brands, they aren't looking to just quickly sell out to the legacy giants. Goodwin is actively preparing for an IPO.
Which is forcing century-old duopolies into a total state of panic. I mean, Pepsi recently acquired the competing brand Poppi for $2 billion just to establish a foothold in the space.
$2 billion. That's real panic money.
Oh, yeah. And there are endless industry rumors of Coca-Cola testing functional, high-fiber products in their traditional red cans. But the underlying demographic shift is already locked in.
Because of Gen Z?
Right. Gen Z consumers have dropped their traditional soda consumption by 60% over the last 10 years. They simply do not have the same internal conflict as older generations who just accepted that an indulgence had to be inherently bad for your health.
So when we pull all of these seemingly disparate sources together, what is the ultimate takeaway for the listener here?
Well, whether you are a multi-manager pod shop navigating portfolio risk by completely avoiding the S&P 500 no-trade zone, or a day trader waiting patiently for the QQQ to fall into a frictionless gap filled below $707, Whether you are tracking commercial smart money data into a massive Bitcoin breakout, or you're a venture capitalist capitalizing on a generational demographic shift away from legacy sugar empires, the lesson is mathematically identical.
Which is?
Successful trading, investing, and business building is exclusively about identifying where the actual momentum is currently flowing. It is never about where you wish it was or where the historical support lines suggest it used to be.
You have to trade the market you actually have, not the market you want.
Exactly.
Well, thank you for diving into the muddy waters with us today. To our listeners, we will leave you with one final thought to mull over. We saw today how changing consumer habits and GLP-1 drugs are completely rewriting the rules for century-old soda empires, and how algorithmic gap fills absolutely dominate the daily trading flow over traditional support lines.
Yeah.
It makes you wonder, what other massive legacy industries or comfortable traditional investing strategies are quietly becoming entirely obsolete right now, without us even noticing until the smart money has already moved on. Keep an eye on those charts, and we will catch you on the next deep dive.